Hey everyone, welcome back to Corporate Decoder. Today, BREIT Incorporated just filed its second quarter 10Q report, and I am seeing some very interesting shifts in their real estate empire. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing shows a clear trend of selling off some properties while doubling down on others. And the numbers reveal a surprising dip in their overall asset value, even as they issue more shares. Let's dive right into the numbers, starting with their balance sheet. As of the 30th of June 2026, Blackstone Real Estate Income Trust, Incorporated or BREIT Incorporated, saw its total assets drop to just over $90 billion. That is down from almost $99 billion at the end of 2025. A big chunk of that decrease comes from their investments in real estate, which fell by about $5 billion. They also sold off a significant amount of real estate loans held by their consolidated securitization vehicles, dropping from nearly $7 billion to just over $4 billion. This suggests they are actively selling off certain assets and possibly paying down debt. Now, looking at their income statement, total revenues for the second quarter of 2026 were about $1.86 billion, a decrease from almost $2 billion in the same period last year. Rental revenue, which is their biggest moneymaker, saw a dip of about $141 million. This makes sense given they've been selling off properties, especially their self-storage segment, which they exited entirely in May 2026. On the expense side, things are a bit more mixed. While rental property operating expenses and depreciation and amortization went down, likely due to those property sales, other costs are rising. The performance participation allocation expense, which is basically a bonus payment to a special partner when the company does well, shot up by over $154 million. This tells us the company performed well enough in certain areas to trigger these profit-sharing payments, even as overall revenue declined. Interest expense also decreased significantly by about $173 million, likely due to paying down debt. All these factors led to a net loss attributable to BREIT stockholders of about $401 million for the quarter. That is an improvement from a loss of nearly $488 million in the same quarter last year, so they are moving in the right direction, but still deep in the red for the quarter. Let's dig into the property details. As of the 30th of June 2026, their investments in real estate, after accounting for depreciation, came in at about $68.9 billion. This is down from over $73 billion at the end of 2025. They've been busy selling, getting rid of 20 rental housing properties, 79 self-storage properties, and 27 industrial properties, bringing in over $2.1 billion in proceeds for the quarter. The sale of those 79 self-storage properties marks their complete exit from that market. But they're not just selling, they're also buying. During the first half of 2026, they acquired 2 rental housing land parcels for about $10 million. And importantly, they deployed a significant amount, over $3 billion at their share, into developing data centers through their QTS platform. These data centers are apparently already 100% pre-leased, which is a very strong sign of demand and good planning. They also acquired 48 net lease properties for around $44 million. So while they're shedding some assets, they are strategically investing in growth areas like data centers and net lease properties. When we look at how they value their assets, especially those that are harder to price, like investments in real estate debt and unconsolidated entities, we see a lot of reliance on what they call level 3 inputs. For investments in real estate debt, the fair value was about $647 million, and for unconsolidated entities, it was over $3.7 billion. These are areas where market prices aren't readily available, meaning management has to make educated guesses using things like market yield data and discounted cash flow models. The weighted average discount rate for these unconsolidated entities was around 8.7%, and the exit capitalization rate was about 5.5%. These numbers are important because even small changes here can significantly impact the reported value of these assets. Looking at their stock and units, they issued over 56 million shares in the second quarter of 2026, while repurchasing about 59 million shares. This slight net repurchase of shares suggests they are trying to manage their share count. The total par value of all their common stock outstanding as of the 30th of June 2026 was about $35 million. Now, let's talk about net asset value, or NAV. This is their estimate of what the company is truly worth, and it is different from the book value you see on their balance sheet. As of the 30th of June 2026, their total NAV was just under $56.6 billion. For their Class I shares, which are a significant part of their holdings, the NAV per share was about $14.53. This NAV calculation takes into account the fair value of their properties, debt, and other assets and liabilities. It is interesting to note that while their GAAP equity was around $21.4 billion, their NAV is much higher, mainly because they're adjusting for things like accumulated depreciation and adding back unrealized gains on real estate. Digging into their same property net operating income, or NOI, which basically measures the profitability of their properties that they've owned for a while, it came in at over $1.2 billion for the quarter. This is a slight increase from the previous year, showing that their existing stable properties are performing well, with rental revenue on these same properties increasing by about $25 million. When it comes to liquidity, they state they have about $8.6 billion available as of early August 2026. This includes undrawn credit lines and unrestricted cash. They also mention generating cash flow from operations and potentially selling off real estate debt investments. This seems pretty solid, giving them a cushion to operate and manage their finances. So what is the story here? BREIT Incorporated is clearly in a phase of active portfolio management. They are selling off some of their less profitable or mature segments, like self-storage, while making significant investments in high-growth areas like data centers and net lease properties. The financials show a mixed picture for the quarter, with increased performance fees and a net loss, but improvements in some expenses and a lower overall loss compared to last year. The NAV calculation shows a much higher value than their GAAP equity, driven by fair value adjustments, which is common for real estate investment trusts. The same property NOI indicates their core long-term assets are performing well. The biggest risk I see is their reliance on fair value estimates for a large portion of their assets, especially those unconsolidated entities and real estate debt. These level 3 inputs can be subjective, and a downturn in the market could quickly reduce the reported value of these holdings. I'll be watching how they manage their debt and whether they can continue to grow their NAV while navigating interest rate fluctuations and potential market volatility. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if you enjoyed this breakdown, hit like, subscribe, and join our Discord.